if you're 65 and older and you're expecting to retire, or you're already retired and you're planning on having a nice pension, going to vacations, all the nice things when you're retired, and then suddenly you realize that the government is actually not giving you your old age security pension, or they're taking some back, this is the video for you. There's a lot of planning that needs to be done with your retirement, and specifically how much income you should have to not cross that threshold where they start taking things back. In this video, we're going to talk about the old age security pension recovery tax, also known as the old age clawback. Okay, so remember, when you're about to be retired or you're retired already, you're pretty much focused on a couple things to fund your retirement: your CPP, your old age security, and possibly your RRSP that you're withdrawing from. And all these things are going to have, an impact on your old age security threshold. So the first thing you need to know is that at some point they start taking your old age security, and if you reach a certain threshold, you receive nothing. You receive $0. So if your net world income, or your net income for tax purposes, threshold amount exceeds the threshold amount, which of course 90,997 for 2024, this is 93,454 for 2025, you have to repay part of that or the entire pension based on your income. Part of your entire pension is reduced as a monthly recovery tax. So if your annual net world income is more than the threshold amount based on 2025, 2026, 2024, and then it's based on your age, whether you're 65 to 74 or 75 and over. So if you're looking at 65 to 74, in 2025, it's $152,062. So if you have a net income for tax purposes of $152,000.62, you're going to receive zero old age security. At any dollar above 93,454, that's when they start taking it and they start reducing it. So for you, your best optimal tax planning is making sure that your net income for tax purposes is less than $93,454 for 2025, so that you receive your entire old age security. Now, you might be wondering, how do we actually calculate the repayment amount? What's really good is that they actually show you, but it's essentially the difference. Okay, your income minus that threshold amount, and then that difference gets multiplied by 15%. So we'll take a look at an example here. Again, these numbers are for 2024. Again, for 2025, this would be 93,454. The threshold for 2024 is 90,997. If your income in 2024 was 98,000, we take the difference of that. So 98,000 minus 90,997, $7,003. And then you multiply by 15%. So you will have to pay back $1,050.45. So you'd have to repay that amount for the July 2025 to June 2026 period. So you have that 1 year extra to repay it. Okay, so, and then they talk about return of income form. So you'll have to fill out another form that you'll have to do to repay it. But we don't even want to get to that stage. We want to make sure that we're planning for that. So what are some important things to consider if we're talking about net income for tax purposes, and we know that you essentially at some point you have some control over that. You have control over how much you want to withdraw from your RRSP. Okay, so that is completely in your control. So let's say you're working, you have employment income, you're still working, and you're at 60,000, then you know that you don't want to withdraw from your RRSP, let's say 35,000, anything to get it above that 93,000 amount. So we know RRSP, we have to look at everything before we start taking out of our RRSP. The next thing we need to consider is our investments. Okay, so the investments we have now, the two strategies really that there are for investments are, you either have growth stocks. Okay, so stocks that you think they're going to grow over the year or over the years, or you have dividend paying stocks. Now, the best thing you can do is make sure that you have dividends in a TFSA. Why? Because dividends actually get grossed up for tax purposes for your net income. Your eligible dividends get grossed up by 38%. You later receive a tax credit. Okay, so that's it. It does work out in the end, but for your threshold, this is very bad for you because it gets grossed up by 38%. Okay, so that means that it's as if you received 38% more of a dividend than you actually did. So you want to make sure that those dividends stay in a TFSA account. Okay, your dividend stocks. Your growth stocks, however, should be in an RRSP account. It won't, you don't want to be collecting dividends and then be taxed on these dividends in a non-TFSA account. So your capital gains, keep it in your RRSP, because that will not, you don't want to have dividends in your RRSP. You want it to be in a TFSA. Now, the final thing here is, remember, your net income also takes into account capital gains, investment income, rental income, all kinds of different incomes. But it's up to you to make sure that you keep it to your best ability to know that you're not over this threshold, so you're able to control it in some certain way. Okay, remember, if you do get hit with over 152,000, you lose all your old age security benefits and you will receive $0. Now, if you are planning on filing your tax return yourself, I recommend using Wealthsimple Tax. That is the tax software that I use. I think it is the most user-friendly. Click the link in the description. If you fund your account, you get $25. And remember, subscribe to this channel if this video helped. There's going to be more practical tax guidance videos in the future. And remember, this is just general information, not personalized tax advice.